Hello everyone. So in this video lecture, we will complete the remaining portion of lecture 20. If you remember last lecture, we talked about, we started lecture 20 and talked about the commercial banks. We just started talking about commercial banks. So in this video lecture, we are going to finish lecture 20 and the chapter 11, the commercial banks chapter. So basically we last class we saw how to do a balance sheet of a bank, and then how we can classify assets, liabilities, and equity. So this class we're going to learn some new terms under the banking operations. So for the first term is called the legal reserves. Basically the legal reserves is basically it's a type of assets that the bank owns, and it can be used to meet the required reserve requirement. So what this means is the legal reserve is actually an asset for the bank, and basically it is equals to the cash in the vaults plus the deposits with Fed. That is what legal reserve means. Basically, when the bank has cash in their vault as well as they have a deposit account with a Fed, when you add these two items, then you get the legal reserve. So it's an asset comprising of the checking account balance as well as the cash that the bank currently has in the branch or in the branches. Um, Now, it does not include, any buildings or cars that the bank might own. It's just an asset that is very liquid and consists of the cash involved and the deposits with Fed, or the checking account deposits the banks have with Fed. And if you see at the bottom of the slide, it does give the formula. So you have to remember this: legal reserve is equal to cash involved plus deposits with Fed. Now here you can also see, the legal reserve can be used to meet the required reserve requirements. So what is the required reserve requirement? That is what our next item or topic is. Basically, the reserve required reserve requirement is something that's mandated by the Fed on the banks. Okay, so now I moved on to slide 10. So the required reserve is a balance, or is a money, or the money that the bank has to keep aside as a reserve because the Fed or the Federal Reserve is requiring them to do so. So let's say if I deposit $100, a certain in let's say I deposit $100 in Wells Fargo is required to keep a certain portion of that $100 as a required reserve, or as a reserve for the bank, because it is mandated by the Federal Reserve, or the Fed, who controls the money supply. So basically the main reason for Feds to mandate this required reserve is basically to control the money supply. They want to control the growth of the money supply. It's not so much to make sure that the bank stays solvent and the bank does not go bankrupt. That's not the main reason. The main reason is basically to control the growth of money supply. And because Fed, one of the main responsibilities of Fed, if you remember from last lecture, is to make sure that the money supply does not grow too fast. If money supply grows too fast, that's inflation. People will not be able to afford the goods and services, which is not good, right? So basically two things we learned. Legal reserve is an asset for the bank that consists of the cash in the vault and the deposits that they keep with Fed. And required reserve is basically a reserve that the bank has to keep or set aside as mandated by the Fed for all the deposits made by customers. Now, how much is the reserve required? Like when I'm depositing $100, how much do I have to keep? How much do they have to keep aside? So that depends from bank to bank. Depends on the type of institution, whether it is a credit union, whether it is a bank, whether it is a small community bank versus a national bank. Then it also depends on the size of the bank, and it also depends on the type of the deposit. So a lot of factors will determine what this required reserve is that Fed is mandating. On average, it is usually 10%. In general, it is usually 10%, but it can vary. It can be 20%, it can be 5%, but on average for all the banks, it's 10%. But let's say if I ask you to calculate, or if I give you a problem, I will probably give you the required reserve rate. Okay, I will tell you if it's 10%, if it's 15%, or if it's 20%. But on average, nationally, it is 10%. Now, the higher the reserve requirement, that means the lower profit the bank will make. Again, let's say the reserve requirement is 10%. What that means is, when I am depositing $100 in Wells Fargo, they have to set aside $10, as reserve, because 10% of $100 is $10. Again, let me do it in the whiteboard so it's clear to you guys. So let's say I deposit $100 and the reserve requirement is 10%. Okay, so that means the banks will have to keep 10% of $100 set as reserve, which is $10. Now, what is remaining? The remaining $90 the banks can loan out. Basically, the banks can use this $90 to give loans to other customers. So that's what you have to remember. Okay, so reserve requirement is something they have to keep aside because it's required by the Fed, and it's done in order to control money supply. The remaining money, the $90, banks can loan out to the customers, as a home loan, as a car loan, personal loan, or commercial loan, whatever, whatever the bank decides to, or wants to do. Okay, so what it's saying is, the higher this rate is, so basically the higher this rate is, now if it was from 10%, if it was, let's say, 20%, then the banks would have to keep, instead of $10, $20 aside, and they could have loaned $80 out, right, instead of 90, because now they have to keep $20 aside as required by the mandate, as required by the, or mandated by the Fed, and which leaves them with only $80 which they can loan out. So that means they will be able to make less profit, right? Because banks make profits by charging interest on loans. Now, where if they are able, if the reserve requirement is higher, it means they can loan out less money, and as a result they will be earning less interest, and therefore their profits will be going down. So the higher the reserve requirement, the lower the profits to the banks, as less funds are loaned out. Now, also, the amount of depositor funds that are above and beyond the required reserve are called excess reserves, and these are usually loaned out. So in this case, if it's 10%, let's say if the reserve requirement is 10%, and then your required reserve amount is $10, and your excess reserve is $90, which you can loan out. Okay, now in case of 20%, the required reserve amount is $20 and the excess reserve is $80. So anything above the required reserve on the deposit is called the excess reserve. So make sure you understand what excess reserve means. It's basically anything above the required reserve is called excess reserve, and this we have to know these terms. So these are very important. We have to understand what does legal reserve mean, what does excess reserve mean, and what does required reserve mean, as it will be used to understand how the money supply changes, or money supply increases when we make a deposit. Okay, so moving on to the next slide. That's the formula for excess reserve: legal reserve minus required reserve. So, but remember one thing, this is only the case when legal reserve is given. If legal reserve is not given, then excess reserve is equal to total deposits minus required reserve. Okay, I want to do write it so you guys can remember, because there are basically two options for this. So make sure you understand and make sure you take note of this. Let me open a new let me open a new let me open a new whiteboard so you can understand. So the two formula for excess reserve that we have to remember is basically is excess reserve is equals to legal reserve minus required reserve. Okay, this is applicable when legal reserve is given. So basically we will use this formula when this legal reserve is given. Okay, now the other formula for excess reserve is basically given by total deposits minus required reserve, and we use this when legal reserve is not given. Okay, so remember these two formulas. Legal excess reserve is basically equal to legal reserve minus required reserve, and we use this formula when legal reserve is given. And excess reserve has another formula, which is basically the total deposits. Let's say the total deposits made in a bank, or what the total deposit balance is with the bank, minus the required reserve, and we use this when the legal reserve is not given. Okay, so take notes of this because we will need these information to calculate. We will have problems like this, so make sure you understand. Okay. Okay, so we will now move to the next. We will do an example of this to see you guys understand what I'm trying to say with this. So you make sure we understand the examples and all that. Okay, so we will do a quick example of this. But before I do an example, I just want to quickly remind you again, the legal reserve of a bank must be in the form of cash in the vault plus the deposit with Fed. Okay, now required reserve is the minimum amount of funds that must be held aside or set aside from customer deposits required by the Fed, and excess reserve is anything that is over the required reserve and can be loaned out. Okay, so let's do an example. Let's say we have Dallas Capital Bank. That's a bank we have in Dallas, and we are given with this information. Okay, let's say their total deposits, the total deposits in all their accounts is equals to 500 million. 500 million. Okay, and let's say the required reserve rate is 10%, that the Fed has decided to put 10% on Dallas Capital Bank based on its size or function, and the type of bank. Okay, and then let's say this bank has legal reserve of 100 million. Okay, so based on this, what is the excess reserve? So that can be a question for you that I can ask you, what is the excess reserve? So again, if you remember, if you see here, we are given with legal reserve. So if we are given with legal reserve, we will use this formula: excess reserve is equal to legal reserve minus required reserve. So first we have to calculate the required reserve, what is mandated by the Fed to set aside, and cannot be loaned out. So first step basically is to calculate. Sorry, this is a new board, so I'm just trying to experiment. So I might be delayed a little bit, but just stay with me. But step one is basically to calculate required reserve amount. We are given with the rate, but we don't know the amount yet. So the amount is basically total deposits. We take the total deposits and we multiply this by the required reserve rate. So 500,000 or 500 million times 10%, that is equals to 50 million. Okay, so that's the reserve. So banks have to keep this aside. Basically banks have to keep this amount aside, 50,000. Okay, now we know the required reserve amount and the legal reserve amount. So what is the excess reserve? Excess reserve is equals to legal reserve minus required reserve, which is equals to, sorry, it's minus, not equals, legal reserve minus required reserve. So that's equals to 100 million minus 50 million, and that's equals to 50 million. So that's the answer. That's your excess reserve. This is the amount of money they can loan out. Okay, so that's what they're trying to say. This is the excess reserve that the bank has, and this is the amount that they can loan out. So that's what we are trying to do in this case. So how is money created? How are we and how are the banks, commercial banks, playing roles in creating money supply into the economy? So let me explain you so you understand. This is very interesting, and let's look how we play, or or the banks play an important role in creating money. So let's say, assume Nafis, that's me. Let's say I deposit $100 in Bank of America, and Bank of America's required reserve rate is 10% by Fed. Okay, so what happens now? So when I'm depositing $100 in Bank of America, what they will do is they will split this into two parts, right? They will keep 10% of the $100, which is $10, as required reserve, and the remaining $90, which is 100 minus 10 is $90, they will use this money and they will loan it out. Okay, so let's say Bank of America now loans this $90, so let's say to Mercedes. Okay, she takes a personal loan. So let's say Bank of America gives her a $90 personal loan, and she gets this loan and puts this money in her Wells Fargo account. Okay, so when she's approved for the loan, the loan money comes into her account, and that goes into Wells Fargo. Okay, now Wells Fargo has another required reserve rate of 10% by Fed. So now out of this $90, $9, which is 10% of $90, will be set aside as required reserve amount, because that's required by the Fed, and the remaining, which is 90 minus 9 is $81, will be loaned out to someone else. Okay, so this process will go on, it will keep going on, until we hit a certain limit. Okay, so there is a multiplication. The money is used again and again, although because of the required reserve, the amount of money decreases. Initially it was 90, now it's 81. Maybe next time we do it, it's going to be even less, but it still goes on. The process continues, and the money supply is multiplying. So that is how we are creating money supply into the economy. Okay, so these transactions affect the money supply. When banks make loans, banks are actually creating money, right? When banks are giving loans, the loans go to the people's account, and basically people use those money to buy things. So it is creating money. Similarly, when money is created in the process, because when bank gives a loan, these funds are spent and deposited by the recipient at another bank, and can be loaned out and deposited in a third bank. So again, the whole process continues. I deposited $100. Bank of America set aside $10 as required reserve. $90 was given out as loan to Mercedes. Mercedes then basically deposits in her Wells Fargo account. Wells Fargo keeps 10% aside, which is $9, and uses the $81 to loan out, let's say, to Patrick. And then Patrick deposits that $81 to his bank account, Chase, and then let's say 10% of that is kept aside, so which is $8.1 is kept aside, and the remaining will be loaned out. So this process goes on until we hit a limit. And this process is known as the money multiplier. Okay, because we are seeing the same money is used again and again to expand the supply of money, and there is the multiplication process. That's why it's called the money multiplier. So basically, commercial banking system as a whole can lend by multiple of its excess reserve, because the banking system as a whole does not lose reserves, right? Because they are lending this money in multiple times, right? The same money is being lent to different people multiple times. So that's why it's called the money multiplier. And I just did an example for you to understand. Now, these are some formulas you need to know. The money multiplier process, we need to know this, basically is given by 1 divided by your reserve requirement amount, not the rate, but it's the reserve required amount. So if we reserve required rate, I'm sorry, let me correct it. Money multiplier is equal to 1 divided by your required reserve rate, not the amount, the rate. Okay, and then we use that money multiplier to see how much the money supply will go up. So, and that's given by excess reserve times money multiplier. Again, basically when I am depositing $100, what's the maximum money supply increase will take place in the economy because of that. So when I am depositing $100 in Bank of America, what is the total expansion of money in the economy because of that activity? So these are the formulas. Remember, money multiplier is equal to 1 divided by reserve required rate, and total expansion of money is given by excess reserves times your money multiplier. So let me do an example so it's clear to you guys. I'm going to be doing an example on this board, so make sure so you guys understand how to calculate money multiplier and how to calculate the total expansion of money. Okay, so let's say we are, this time let's take a thing. Let's say Tom deposits $1,000, okay, in Chase Bank. Okay, and the required reserve in that bank is 10%. Okay, now because of this, what is the total expansion of money supply? By how much the money supply will go up? That's my question. Okay, so first step is basically step 1 is to calculate how much they are, calculate the excess reserve. In order to calculate the excess reserve, we need to find out. And here in this case, if you see, the total deposit is not, in this case legal reserve is not given, so we will use total deposit minus required reserve amount. So what is the required reserve amount? Out of $1,000, 10% has to be set aside by the Fed. So that means $100 has to be set aside, right? So 1,000 times 10% is equals to $100, and that's your required reserve amount. Okay, so now total deposits we know is $1,000 minus your required reserve amount is $100. So $900 can be loaned out, correct? That's step 1. We first have to calculate the excess reserve. Okay, so that's step 1. Now step 2, we have to calculate the money multiplier, and money multiplier is given by 1 divided by required reserve rate, which is equals to 1 divided by 10%. The required reserve is 10%, and that is equals to 10. So the multiplier is 10. And the final step, which is step 3, is total expansion of money, is given by excess reserve times multiplier. We know the excess reserve is 900. We know multiplier is 10. So basically 900 times 10 is equals to $9,000. So just because Tom is depositing $1,000 in Chase account, in his Chase account, he's depositing cash of $1,000 in his checking account in Chase, it's gonna increase the money supply by 900,000. That's exactly what this problem is trying to say. That's what happens. You know, that's how the banks, by giving loans from, this happens because, you know, basically they, when the Chase, this $900 they give out as loan to someone else, and then they deposit the money again to their own bank, let's say to Wells Fargo, and Wells Fargo will loan out again. So this process continues. So the maximum expansion that will take place is $9,000, because when Shaikham or when Tom basically deposits $1,000. So this multiplier process can be limited by two things. So, you know, when Tom is depositing $1,000, the maximum money supply that can happen, the maximum increase in money supply that can happen is $9,000. However, this maximum increase in money supply can be limited by two actions or by two factors. Number one is when individuals may hold some of the money as cash from their loan. So let's say again, let's say Tom deposits $1,000, and then Chase keeps $100 aside and gives $900 to Maya. Okay, now Maya decides, when she gets this $900 as loan, she decides to buy a new laptop, but her new laptop is only $700. So she's gonna spend $700 and put it in the account for, let's say she's buying from Dell, so Dell, it will go to Dell's account, the $700. But what happens to the remaining 200? She's holding it back. She's not putting it, she's holding it as holding the money back as cash. So that's why this will limit the amount of multiplication, or this will limit the multiplication process. So if people are not spending all their loan amount and keeping some amount as cash, that will reduce or limit the multiplication process. Now, the second reason why the multiplication process may be limited is when banks do not fully loan out. Okay, so let's say again, Tom depositing $1,000, then to Chase. Chase decides to keep $100 as required reserve. Now they have $900 as money that they can loan out, but they decide they will only loan out $500. They want to keep the extra for safety reasons, or maybe there's recession, they don't want to give out everything for loan, so that extra 400 they are not loaning out, so that's not playing a role in multiplying the money supply. So that's why that can limit your money supply. So two things: banks, if they are not loaning out fully, and secondly, if people are holding back some of their money when they are getting the loans. Especially during recessions, banks will often maintain a safety margin and do not lend their full or excess reserve. And borrowers may also not be willing to borrow during recessions because it's not a good time. Economy is not doing well. Okay. Let me do another example for you guys so it's clear to you how this process works. Okay, so as an example, let's say we are given with Bank of America's or Bank A's balance sheet as on December 31st, 2019. And by now you know what a balance sheet means and how it looks like. On the right hand side, we have the assets. On the left hand side, we have liabilities on top, and we have net worth at the bottom. Okay, and let's say assets were given. You have legal reserve for the bank, and it's, let's say, assume it's 300K, it's given. Then you have loans to clients, home loans, car loans, that's, let's say, 500K. Then let's say security investments made by the bank, that's another 300K. Okay, and let's say they have a building and it's 2 million. Okay, so total assets is actually equals to 300 plus 300 is 600. 600 plus 500 is 1.1 million. 1.1 million plus 2 million is 3.3 million. That's the total assets of the bank. Now let's say The liabilities, we assume this bank only has checking account deposits, no savings accounts, but they might have. And then the balance is 1.1 million. That's the only liability. So net worth will be equals to total assets minus liabilities, which is 3.3 million minus 1.1 million, which is equivalent to, actually I'm sorry, it's 3.1 million. I made a I made a small mistake here. It's actually 3.1 million. If you add them up, it's 3.1 million, the total assets, because 300 plus 300 is 600k, 600 plus 500k is 1.1 million, 1.1 million plus 2 million is actually 3.1 million. My bad, I'm sorry about that. Total liabilities is, let's say, 1.1 million, which is just the checking account. So net worth is basically 3.1 million minus 1.1 million, and that is equals to 2 million. Okay, let's say we're given with this, but we are also given that the required reserve is 20%. For this bank, the Fed has said the required reserve rate is 20%. So based on this, I will ask you to calculate what is the excess reserve. Okay, how much money can they loan out based on this? This is a different way of presenting you the data, and you have to figure out how you can calculate it. Okay, so first step is basically calculate the required reserve amount, right? Required reserve amount is equals to your total deposits times your required reserve rate. Now total deposits is all the money in your checking account. If you had savings accounts, then you would have added the checking account plus savings account. But in this case, we don't have savings accounts, so we will take the total deposits in checking account, which is 1.1 million times 20%. Okay, that is equals to 220,000. So that's the required reserve amount. Now, what is excess reserve? We know here in this case, legal reserve is given. So excess reserve is equals to legal reserve minus required reserve amount, which is equals to 300k minus 220k, and that's equals to 80,000. This is the amount of money that the bank can loan out to, or this is the amount of money available that's left over that they can give out as loans to clients or to customers for, car loans, home loans, commercial loans, or whatever. So that's another way I can give you the data, and you basically have to calculate the excess reserve and required reserve amount based on this. So hope this example clarifies what we are trying to do, what we mean by excess reserve, what we mean by required reserve amount. In this case, the 220,000, this is the amount of money that the Fed has required us to set aside. So out of this 300k legal reserve, 220 is required reserve, and the remaining 80,000 is a reserve that the bank can loan out. It's something over the required reserve amount. Moving on to the next slide, which talks about monetary policy. Now, chapter 12 is all about monetary policy, but chapter 11 gives you a little bit of background about what this policy means and gives you a head start to this process. This monetary policy itself is a big topic. Chapter 12 is all about monetary policy, but there is a little bit of introduction about monetary policy in this chapter towards the end of chapter 11. Okay, so the process or the policy by which we control the money supply is called the monetary policy. Now, it consists of several tools. There are several tools that the government can use to control the money supply. And we saw the required reserve amount, when Fed is setting the required reserve rate 10% or 20% or 15%, they can control the money supply, right? That's one of the tools. But in chapter 12, we will see there are other tools available in order to control the money supply. So again, if you look at the required reserve rate, if it's 20%, that means money supply will decrease. If it's 10%, money supply will go up. So higher the required reserve, lower the money supply, lower the required reserve, higher the money supply. But we will talk in details about these in the next chapter, in chapter 12. But there are basically several tools to control the money supply. Now, monetary policy can be of two types: easy monetary policy or tight monetary policy. Easy monetary policy is when we are trying to increase the money supply, and tight monetary policy is when we are trying to decrease the money supply. We will use the easy monetary policy during recessions, like during this time when the economy is slowing down, people are losing jobs, there's not much economic activity going on. So we will try to increase the money supply so that people have more money in their hands, and that is called easy monetary policy. On the other hand, during inflationary period, when prices are going up really fast, we will use tight monetary policy. We will basically reduce the money supply so that money supply does not grow too fast. Overall, there must be a healthy balance between maintaining banking stability for the nation and allowing banks to operate profitably, and necessary liquidity to borrowers. Banks do play an important role in the economy by providing funds for credit markets, as well as plays an important role in the money supply. Okay, it facilitates savings and investments process. Now, it also depends how the operation of the banks also depends on the trust and confidence of public, right? If public don't have confidence in bank, they will not put their money in the banks, and so therefore confidence in the banking sector is important. And also the Federal Reserve has to commit that in case the banks fail, they will basically protect their deposits. So these are important factors. Okay, so with that slide, we wrap up the chapter 11. That's the end of this video lecture. This week we will focus on lecture on the last chapter, chapter 13, which is our next video lecture. That is basically a summary of all the chapters we have learned so far. Basically talks about all the topics we mostly discussed about. It does introduce a couple of new topics. It may be an extension of unemployment and inflation, or extension of some of the trade-off or opportunity cost. So we will basically look into those this week in the lecture, and then next week we will look into monetary policy, because that's a broad topic and will take a lot of time. And after that we have our final exam. But basically in this week we will cover lecture 21, and then next week we will talk about monetary policy. But with this I will end this lecture, and this week you have another video lecture, which is basically chapter 13. Well, you guys stay safe. Thank you very much. Bye.